हेलो, माइक टेस्टिंग बराबर है? Hello everybody, very good evening. How are you all doing? All good with you? So today we are supposed to start with unit 3 of the theory of demand and supply. Hi Sanjay, very good evening. How are you doing? Hello David, all good with you? I hope you all have come revised with chapter number 2, utility, and on public demand we are also going to cover theory of the chapter by the name of money market. That is your chapter number 8. All right, so whenever we talk about the concept of utility, now what do we mean by utility? So dear students, utility is the want satisfying power of a commodity. Now we need to understand that want and want satisfying power are not the same. Whenever we use the word want is of a human. Humans have wants, and want satisfying power is always in a commodity. So remember that want and want satisfying power are not the same. Want is different, want satisfying power is different. Yes or no? So Sanjay, if I am hungry, my want is to satisfy my hunger. What helps me satisfying my hunger is a idli, vada, poha, upma, pav bhaji. So poha, upma, vada, all these are nothing else but commodities. Hi Nandini, very good evening. So remember that want and want satisfying power are not the same. Want is different, want satisfying power is different. Want is of a consumer or a human, whereas want satisfying power is in a commodity. So if I want to write, what is my want? My want is to write. What satisfies my want of writing is a commodity. That commodity is nothing else but a digital pen. Yes or no? Sanjay, David, Nandini, are we clear with that? So remember that want and want satisfying power are not the same. Want is different, want satisfying power is different. Give me a reply in the chat box if you have understood this. Whenever we talk about utility, utility is the want satisfying power of a commodity. Utility is a subjective concept, that is, it will differ from person to person. Utility does not always mean usefulness. So certain times we say that cigarettes have utility, liquor has utility, but they are not useful, they are harmful. So utility and usefulness are not the same. Hello Shivani, hello Surya, welcome to today's class. Then utility is ethically neutral. It does not distinguish between what is good and what is bad. At the end of the day, economics considers a want as a want, a good want, a bad want. Such classification is not done under the concept of utility. Utility can be from good things, utility can be from bad things also. Education is ethically good, but cigarettes are ethically bad. Business economics or utility does not consider the difference between what is good and what is bad. Therefore, utility is ethically neutral. We all know that human wants are unlimited and all wants can be satisfied. But since the resources are less, not all human wants are satisfied. Consumer will always spend his income in a manner through which he receives maximum satisfaction. And for the purpose of understanding utility, we have two measurements. One is by the name of cardinal, other is by the name of ordinal. Cardinal measurement is measurable and quantifiable in terms of utils. This is an assumption given by Alfred Marshall. Whereas ordinal utility is not quantifiable, it is measured in terms of ranks and preferences given by a person by the name of Hicks and Allen. Now, whenever we talk about utility, you need to know that under utility we have a concept called as total utility. And then there is something called as marginal utility. So, what is total utility and marginal utility? Total utility is the sum of all the units. Total means aggregate. Total means sum. Total means utility from all the units consumed. A yes or no? You need to keep replying in the chat box so that I know that you all are understanding. Then there is marginal utility. Marginal means the additional utility or the extra utility or the utility from last unit. So we need to study two concepts. One is by the name of total utility, another by the name of marginal utility. As the consumer consumes more units of a commodity, his total utility increases but at a diminishing rate. Absolutely correct, Nandini. Marginal utility is addition made to the total utility. Absolutely correct. So 10, 8, 24, 28, 30, 30 and 28. Utility is measured in a theoretical concept called as utils. This is a cardinal measurement, something which can be measured in numbers. Utils do not exist in reality. Now, what is the marginal utility? It is 10, 8, 6, 4, 2, 0 and minus 2. So, marginal utility keeps on diminishing. And therefore, we have studied the law of diminishing marginal utility. As the consumer consumes more unit of a particular commodity, the additional satisfaction received by the consumer diminishes. So total utility is the summation of marginal utility, whereas marginal utility of n is equal to total utility of n minus total utility of n minus 1. Absolutely correct, Surya. So Surya, can I say n over here represents the number of units? So how did we get marginal utility? 18 minus 10, 8. 24 minus 18, 6. 28 minus 24 is 4. 30 minus 28 is 2. This is the way we calculate marginal utility. Now marginal utility of n is the change in total utility upon the change in number of units. So this samosa, this triangle, this is nothing else but marginal. This is additional. This is extra utility. A yes or no? Are we clear with that? Have we understood it? Chalo, everybody give me a reply. Are we clear with the concept of total utility, marginal utility? This is the diagram that we need to draw. There is total utility and marginal utility on the y-axis. Number of units is on the x-axis. Initially, total utility and marginal utility start from the same point. total utility rises at a diminishing rate, then it becomes constant and maximum. So over here total utility is maximum. We know when total utility is maximum, marginal utility is 0, and then total utility falls because marginal utility becomes negative. This is your marginal utility curve. So when marginal utility is positive, total utility increases but at a diminishing rate. When marginal utility is 0, total utility is maximum or constant. And when marginal utility is negative, total utility falls. Yes, dear students, are we clear with this table, diagram and formula? Absolutely correct, Surya. Very good, Saranya. Okay, Nandini, thank you so much. Chalo, are we all clear? Have we understood this? Do we have any questions, queries or doubts? Do I need to explain this concept to anyone? Is cardinal measurement clear to one and all? Absolutely correct, Surya. When marginal utility is negative, total utility diminishes or falls. Chalo. If there are any doubts, do let me know in the chat box. I hope we all are clear. Now, there is a concept called as consumer surplus. So, dear students, consumer surplus is a situation where the price willing to pay minus the price actually paid. So I am a big fan of the movie Pushpa. I am willing to pay 500 rupees for that movie. But when I went to the theater, the actual price that I paid was only 300. So was there some extra utility? So consumer surplus can also be termed as extra utility, wherein I am getting a surplus of 200. So what is consumer surplus? It is the price that you are willing to pay minus the price that you have actually paid. The price that you are willing to pay is the maximum price, and the price that we have actually paid is the market price. In economics, the maximum price is nothing else but your satisfaction, whereas the market price is the sacrifice. We denote satisfaction in the form of mu of x, whereas sacrifice in the form of price of x. So what are the formulas of consumer surplus? It is the price willing to pay minus the price actually paid. It is the maximum price minus the market price. It is the satisfaction minus the sacrifice. And it is the mu of x minus the price of x. Hello, Surya. Yes. Chalo, are we all clear? Ordinal utility is about indifference curve analysis. We will come to that, but before that we need to understand the concept of consumer's surplus. Are we all clear? Are we sure? Is there any question, any queries or any doubt? Are we sure? Chal. So going on to the next part. There is a diagram to understand the concept of consumer surplus. On the x-axis, we have number of units. Okay, Nandini, Surya. And on the x-axis, we have mu of x and price of x. Yes or no? Now, can I say we are assuming that consumer surplus we are studying in perfect competition. And dear students, when we study perfect competition, we get a price which is constant. So this is my price curve P of x, which is a horizontal line parallel to x-axis. This is the MU curve. Marginal utility diminishes. This is the point of equilibrium. This is the point of origin, and these are the number of units which I will consume. So how much is the willingness to pay in the diagram? Can I say that I am willing to pay till the point of marginal utility? This is the willingness to pay, that is OMEQ. But have I paid that much? No, I have paid only this much, minus OPEQ. So I have a balance. This balance area which I get is the consumer surplus. So what is consumer surplus? It is the price that I am willing to pay, OMEQ, minus the price that I have actually paid, OPEQ. So the balance PME is my consumer surplus. At consumer surplus, MU of X is greater than price of X. But at point E, we get consumer equilibrium. Consumer equilibrium is at a point where MU of X is equal to price of X. Yes, dear students, are we clear with this? Have you understood the diagrammatic representation? Absolutely correct, Surya. Do you agree? Are we clear? Have we understood? Give me a reply in the chat box. The blue color is the price that I am willing to pay. The red color is the price that I have actually paid. The green color is the surplus. A consumer is at equilibrium at the point where MU of X is equal to price of X. Absolutely correct, Surya. What about others? Nandini, David, are we clear? Saranya? Shall I go to the next part? So basically this was the difference between cardinal and ordinal. This is the concept of cardinal approach in which we study marginal utility. We know the assumptions of the law of DMU. What is the law of diminishing marginal utility? This is the graphical representation of consumer surplus. So as I told you that when we study utility, there are two approaches. One is marginal utility approach. The other is indifference curve analysis. Ordinal deals with ranks and preferences. Bolo, are we all clear? Cardinal measurement or marginal utility was given by Alfred Marshall. Indifference curve is given by Allen and Hicks. In marginal utility, there is cardinal measurement. Over here, we have ordinal measurement. When we study marginal utility, we study the law of dmu, that is mu of x and price of x under one commodity, law of diminishing marginal utility. But when we study more than one commodities, then it is the ratio. Mu of x upon price of x should be equal to mu of y upon price of y, which should be equal to a constant. So law of dmu is for one commodity, whereas law of emu, equimarginal utility, is for more than one commodities. When we study indifference curve, we study ranks and preferences, and the formula for MRS is P of x upon P of y. Absolutely correct, Surya. So there is a concept called as scale of preference. The concept of scale of preference explains higher the combination of goods, higher is the level of satisfaction. Under the ordinal approach, we have minimum two commodities. Now under the concept of two commodities, more the combination of goods, more is the level of satisfaction. Larger the combination of goods, larger is the level of satisfaction. Smaller the combination of goods, the smaller is the level of satisfaction. So if there are two commodities X and Y, and if they have a direct relationship, I will give first rank to a larger combination, second rank to a lower combination, and third rank to the least combination. So what did you understand over here? Over here we understand larger the combination of goods, larger is the level of satisfaction. Lower the combination of goods, lower is the level of satisfaction. But when we talk about indifference curve analysis, indifference curve analysis, the relationship is inverse. So if one commodity increases, another commodity decreases in such a manner that my level of satisfaction remains the same. We assume that these are imperfect substitute goods. So if I am increasing the consumption of one, there will be a reduction in consumption of another. Imagine if commodity Y is consumed less, then the level of satisfaction will fall down. So to compensate the loss of satisfaction, I will increase the consumption of another commodity in such a manner that my level of satisfaction remains the same. So all the points on one indifference curve gives you the same level of satisfaction. Do you agree? Are we sure? Can I have a reply in the chat box? Can I have a reply? Yes, dear students, have you understood? So the indifference curve analysis teaches us that all the points on one indifference curve gives us the same level of satisfaction. If commodity Y's consumption is reduced, we will increase the consumption of X in such a manner that all the points give us the same level of satisfaction. Over here, the MRS, that is marginal rate of substitution, will be 4, 3, 2, 1. So because the MRS is diminishing, the curve is convex to the origin. And because the relationship is inverse, the curve is downward sloping. Do you agree? So what are the properties of indifference curve? The very first property is indifference curves are downward sloping because there is an inverse relationship. Second property, indifference curves are convex to the origin because MRS, the marginal rate of substitution, is diminishing. I substituted 4 units of X, 4 units of Y for 1 unit of X. I substituted 3 units of Y for 1 unit of x. So my marginal rate of substitution is 4, 3, 2, 1, which is diminishing. Therefore, the shape of the curve is convex. So the first property is that indifference curves are downward sloping. Second property is they are convex to the origin. The third property is higher the indifference curve, higher is the level of satisfaction. So if you see the indifference map, how many curves have I drawn? 1, 2, 3. The curves are going to the right of the previous one. So higher the indifference curve, higher is the level of satisfaction, which means IC3 is greater than IC2 is greater than IC1. Then two indifference curves cannot intersect each other. So if you see this example, I have drawn two indifference curves which are intersecting. Now A and B are on IC1. According to the property of indifference curve, all the points on one indifference curve give you the same level of satisfaction. So A is equal to B. On IC2, we have B point and C point. A yes or no? So according to the indifference curve theory, B is equal to C. Now BB will get cancelled. Therefore, A is equal to C. And if A is equal to C, it would mean that IC1 is equal to IC2. Can IC1 be equal to IC2? Because just now we studied higher the indifference curve, higher is the level of satisfaction. So please remember that all the points on one indifference curve give the same level of satisfaction. But these blue color dots will give a larger satisfaction than red color ka dots. And the green color will give the maximum level of satisfaction because they are on a higher indifference curve. Yes, dear students, are we clear? Are we understanding? Please give me a reply in the chat box. So the first property was indifference curves are downward. Second property, indifference curves are convex. Third property, indifference curves, higher the indifference curve, higher is the level of satisfaction. Fourth property, indifference curves cannot intersect each other. And fifth property is indifference curves are dashed cannot touch the axis. Do you agree? Are we sure? Have we understood? Pakka. And final property, they cannot touch the axis because the very first property says that it should be downward sloping. Second property says that it should be convex to the origin. So none of these curves are downward or convex to the origin. We need minimum two commodities. Therefore, they cannot touch the axis. If it touches the x-axis, y coordinate is 0. If it touches the x-axis, y-axis, then x coordinate is 0. If it touches the x-axis, y coordinate is 0. So we need minimum two commodities. Are we all clear? Then there is a concept called as budget line or the price line. Now whenever I talk about the budget line or the price line, can I say that all the points on the budget line give the same level of output, or rather same level of cost to the consumer? So when we talk about a budget line, please understand that a budget line is a concept where all the points on one budget line give the same level of total expenditure to the consumer. So there are three possibilities. Either you can be on the budget line, outside the budget line, or inside the budget line. So you tell me, where should the consumer be? Should the consumer be outside the budget line, or should they be inside the budget line, or should they be on the budget line? Where should the consumer be? Yes, budget line is a downward sloping curve because again the relationship between X and Y commodity is inverse. So there are 3 points: on, outside and inside. Where should the consumer be? Should the consumer be outside the budget line? Should he be inside the budget line? Or should he be on the budget line? See, outside the budget line is outside the consumer's budget. Inside the budget line will mean that consumer is underutilizing his budget. So the concept is that you should be on the budget line. That means you are optimally utilizing your resources. A yes or no? Can I have a reply in the chat box? Are we understanding? Only Surya is answering. What about others? Can I have a reply in the chat box? Do you want me to explain anything again? So on the budget line represents that combination which gives us the same total expenditure. Consumer should be on the budget line. Now where is the consumer at equilibrium? So the concept of consumer equilibrium is at a point where indifference curve is a tangent to the ISO, or indifference curve is a tangent to the budget line. So this is my IC1, this is my IC2, this is my IC3, this is the IC4 and this is IC5. 4 and 5 are outside the budget line. So tell me, where am I at equilibrium? P, Q, R, S or T? Where is a consumer at equilibrium? Is he at equilibrium at P, Q, R, S or T? These are the different curves: 1, 2, 3, 4, 5. 4 and 5 are outside the budget. 1, 2, 3 are on the budget line. But yes, Surya, absolutely correct, Nandini. Well done, good job. What about others? Do we have anybody else in the class? Can I say P, Q, R, S, T? All these points are on the budget line. But P, Q, S, T are on lower indifference curve. We need a higher indifference curve. So there are two conditions for consumer equilibrium. The first condition is that you should be on the budget line. The second condition is that you should be on a higher indifference curve. And this is about it from chapter 2, unit 3. Cardinal measurement, ordinal measurement, indifference curve analysis. So dear students, you have another 5 to 10 minutes. Go through the utility analysis chapter, solve MCQs. If you have any doubts, let me know. I'll give you a total of 10 minutes. Revise and ask doubts if any. I have received reply only from 2 people. That is Surya and Nandini. I have no idea about others. Would be nice of you if you reply. Is there anyone who has any doubts? Yes, Surya, Nandini. Can I help you with something? Do let me know in the chat box. These are a few MCQs which, if you wish, you can solve. After this, I'll be starting with chapter number 8. Surya, have you come revised with chapter number 8 today? Have you marked down certain doubts that you have? So total utility is maximum when marginal utility is 0. Easy peasy lemon squeezy. Similarly, you can solve the rest of the MCQs. Okay, Surya. So in the next 5 minutes, maybe we will be starting. 5 to 7 more minutes and I'll be starting. In the meantime, I'm waiting for all those who have doubts in chapter number 2. So Surya, I will be covering all those aspects in which you have a doubt from chapter number 8. I hope that works for you, Surya. Seems that people don't have doubts only in microeconomics. Some exams are going on, Surya. Are there some exams which are going on in Chennai? Some prelims or some college exams, I don't know. Okay. So there are no doubts in microeconomics, it seems. You people seem very confident in micro. Is my understanding correct? Yes, Nandini. Is there any doubt or a question or a query that you have? Please let me know. What prelims are going on, Surya? CA Foundation exams? Okay, Nandini. That's wonderful. Is there anything that I can help you with, Nandini, in chapter number 2? Any other concept that you want me to solve? Let me know in the chat box. Accounting. Okay. So are these prelims related to your CA foundation exams? Accounts paper, is it related with your CA foundation exam? Okay. All right. Last couple of minutes. In case you have any questions or doubts in chapter number 2, you can be solving MCQs from the ICAI material. There are so many MCQs in the ICAI material. So Surya has a doubt in MRS. Surya, MRS means the marginal rate of substitution. So when I had explained you the indifference curve table, MRS means the change in Y due to change in X. Yes, Surya. So how much of Y did we lose? 4 units. To gain 1 unit of X. So change in Y is 4 and change in X is 1. So your MRS is 4. Similarly, for the next one, the marginal rate of substitution is 3. For the next one, the marginal rate of substitution is 2. And for the last one, it is 1. So what is happening to MRS is that MRS is diminishing, Surya. Are we now clear? Why is the MRS diminishing? Because the goods are imperfect substitutes to each other. So if the goods are imperfect substitutes, then MRS will diminish. If the goods are perfect substitutes, then MRS is constant and the curve is linear. So when the goods are perfect substitutes to each other, MRS is constant and the curve is a downward sloping linear curve. When the goods are imperfect substitutes like ice creams and chocolates or pastries and ice creams, then these goods are termed as imperfect substitutes, because of which the marginal rate of substitution diminishes. And because MRS diminishes, the shape of the curve is convex. All right, then Surya is clear. What about others? Nandini, Surya, Faridul, David. Chalo, if everybody is clear, post in the chat box clear. If we all are done with this chapter, let me know in the chat box. Clear, clear, clear. Everybody, only 2 people reply. I don't understand this. Thank you, Shivani, the third person to reply. You all should at least reply saying yes, sir, understood, sir, clear, sir, not clear, sir, explain it again, sir. How would I know that you have understood or not? Chalo, be kind enough to reply in the chat box. Kamal is clear. Surya, thank you so much for your reply. All right. So I think we should be going to the next chapter, which is by the name of money market. Now what I believe is already the revision for macroeconomics is done, but I am still covering some parts of money market because there are a few students who have doubts in the chapter of money market. So how do we define money? Money is something which is used as a medium of exchange. But in today's world, money is a medium, measure, standard, and store. So what are the 4 functions of money? Medium of exchange, unit of value or account, standard for deferred. Deferred means delayed payments, and money is used as store value. So money is a measure for medium, measure, standard, store. MMS square. Money is used as purchasing power. All medium of exchange are not money, because today money should have additional qualities like medium, measure, standard, store. It is a liquid asset, no intrinsic value of currency. It can be printed on the authority of the government. There can be electronic records. Money should be generally acceptable, durable, effortlessly recognizable. It should not be easy to counterfeit. It is relatively scarce. It should be portable, that is easy to transport. It should be uniform, same size, same color. It should be divisible into smaller parts. So this is very important. What is the demand for money? Demand for money is to hold the money. It is the demand for liquidity. A yes or no? So there are certain theories that we have studied in money. There are 3 concepts: demand for money, supply for money, and the monetary policy. Now when we talk about demand for money, can I say demand for money is the desire to hold the money? The amount of money that we hold with ourselves is called as the demand for money. There are 6 theories. The first theory is cash transaction approach. Cash transaction approach was given by Irving Fisher. In the year 1911, in his book The Purchasing Power of Money, where he assumed that money has only one function, that is a medium of exchange, and the formula is MV is equal to PT. So for example, there are 1,000 transactions in our economy. Price of every transaction is ₹10 on an average. So 10 into 1,000, 10,000 is the demand for money. The RBI circulates money which has a velocity, say, of 5. Velocity of 5 means that money exchanges hands 5 times. So RBI will circulate only 2,000. So M for money circulated, V for velocity, P for price, and T for transaction. MV should be equal to PT. But in today's world, we don't only have money in cash, we also keep it in bank. So MV was cash, M-V- is with bank. M dash is the money circulated in banking system. V dash is the velocity of the banking system. So the total of MV plus M dash V dash should be equal to PT. PT is the demand for money. MV is the supply of money. Yes, Surya, are we clear with the first theory, cash transaction approach, where money has only one function, which is by the name of medium of exchange? Do you have any questions, Surya, in the very first theory? Surya, are we clear? Have you understood? Are you sure? Then there is a concept called as cash balance approach, given by A.C. Pigou or Alfred Marshall. They believe that money has two functions, that is transaction and precaution. No, sir. No, for what, Surya? You have understood or you have not understood? Okay. So under cash balance approach, we have two functions of money. One is a medium of exchange, another is store value, and the formula is MD is equal to KPY. MD is the money demanded. K is a fixed proportion of income that we want to save. PY is your national income. So if India's national income is 1 lakh, 20% is what we want to save for precaution. Then 20,000 is the money demanded for precaution. Money demanded is the money that we hold for the purpose of spending. Do you agree? Are we clear? So this was your second theory, which is by the name of cash balance approach. Cash transaction approach was given by Irving Fisher, whereas cash balance approach was given by Alfred Marshall. One is from Cambridge University, one is from Yale University. In cash transaction, money has only one purpose, medium of exchange, whereas in cash balance, money has two functions, that is transaction and precaution, medium of exchange as well as store value. Then comes the Keynesian theory, where money is used for transaction, precaution and speculation. So beta, money demanded for transaction and precaution, we say it is income elastic. Higher the income, higher the money demanded. Lower the income, lower the money demanded. Relationship is direct. Income and money demanded. Similarly, we say that it is interest inelastic, which means if the rate of interest is high or low, money demanded for transaction and precaution will remain constant. So according to J.M. Keynes, there are three motives: transaction, precaution and speculation. Transaction and precaution are income elastic, whereas speculation is interest inelastic. Elastic means dependent, inelastic means not dependent. So the money that we hold for transaction and precaution is not a function of interest, but the money that we demand for speculation. Can I say money demanded for what? Speculation is income elastic and it is interest elastic as well. So if income rises, demand for money will rise for speculative purpose. If income falls, demand for money will fall for speculative purpose. It is dependent on rate of interest as well. Rate of interest is high. Should we hold more money or invest? We should invest. So when the rate of interest is high, money demanded for speculation is less. And when the rate of interest is less, money demanded for speculation is high. Therefore, the relationship is inverse. Yes, Surya. Are we clear with that? Because the relationship is inverse, the curve is downward sloping, and at 2% rate of interest, we believe that there will be a liquidity trap, because the rate of interest in an economy will not go below 2% is an assumption made by J.M. Keynes. Chalo. Let me know in the chat box. Are we clear? The first theory is by the name of cash transaction approach. Second theory is by the name of cash balance approach. Third theory is by the name of liquidity preference theory. Yes, Surya. I believe you had certain doubts. Are there any doubts till now? Yes, Surya, I am waiting for your reply. Are we clear? Is there something that I should explain you? So there is one concept which says that if the current rate of interest is 10% or rather 8% and the normal rate of interest is 6%. So Surya, tell me, what should the person do? Current rate of interest is 8. Normal rate of interest is 6. What should the person do? Should he hold more money or should he hold less money? What should the person do if this is a scenario? The person should invest and hold less because he is getting higher rate of interest. So his bonds or interest yielding asset, less money will be held. Because first of all, you are getting higher rate of interest, and secondly, if the rate of interest comes back to normal rate of interest, then your bond will get a capital appreciation. So if rate of interest is high, money demanded is less. If rate of interest is less, money demanded will be more. Now, there are three more theories: inventory approach theory, Milton Friedman's theory, and risk behavior towards risk. So inventory approach, according to Baumol and Tobin, money is to be considered as a real cash balance. Money should be considered as stock. Money should not be kept for transaction, precaution and speculation, separate purposes. Money can be utilized for any purpose. Then Milton Friedman, according to him, can I say he believed that after transaction, precaution and speculation, a person should invest in physical assets. Why physical assets? Because property, gold will give you capital appreciation, and property will give you a fixed income in the form of rent. So Friedman's restatement of quantity theory was given by Milton Friedman, where he believed we should invest in physical assets because of two reasons. One is permanent income and second is relative return on assets, which is capital gain. And then Tobin gave a theory by the name of behavior towards risk. Now every person's risk appetite will differ. So higher the risk, higher the return, lower the risk, lower the return. If I am a risk averse person, I will take lesser risk. In order to get higher returns, I will have to take more risk. But I am a person who is risk averse. I don't like to take risk. Yes. So see, before I got married, my risk taking abilities were much higher. Then I got married, all my risk went. Now I have a child, so my taste of assets also changes. Before I got married, I invested everything in stock market. When I got married, I started a mutual fund. Now I have a child, I have started investing in PPF. So the taste of the individual towards the asset will also change. So in total, we have 6 theories. First one is by the name of cash transaction approach. Second one is by the name of cash balance approach. Third one is by the name of liquidity preference theory. The fourth one is by the name of Baumol and Tobin gave inventory approach, where money has to be treated as stock, as a real cash balance, where they discussed about transaction cost. So when we convert our cash balance into bond balance, we have to pay a brokerage fee. The fifth one was by the name of Milton Friedman's restatement of quantity theory. Restatement of quantity theory. The sixth theory was by Tobin, that is liquidity preference as a behavior towards risk. Liquidity preference as a behavior towards risk. So tell me, is there any of the theories that you want me to discuss? Under cash transaction, medium of exchange, cash balance, transaction, precaution, medium of exchange, store of value, liquidity preference, transaction, precaution and speculation. Fourth, inventory approach, wherein we discussed about money to be treated as a stock and not to be treated for transaction, precaution and speculation. We also consider the concept of transaction cost, that is a brokerage fee. Restatement theory or quantity theory, restatement of quantity theory, where we talk about physical assets. And finally, liquidity preference as a behavior towards risk. Chalo, do we have any doubts, questions or queries? Do let me know in the chat box. Yeah, are we all clear? Are we understanding? Surya, I have no reply from you. Nandini, Shivani, Kamal, have we all understood all the theories? Is there any theory that you want me to repeat? See, my basic assumption is that you know some basic concepts. I don't know how much you know and how much you don't. So if you want me to discuss any theory in detail, you will have to let me know. I have given you a short revision of all the 6 theories. So can I have reply in the chat box from everybody? Understood or not understood, clear or not clear? So Milton Friedman's theory. So Surya, under the Milton Friedman theory, we say that money is used for transaction, precaution and speculation. You have already invested in share market or in a bond market. Now you tell me, after transaction, precaution and speculation, if more money is left, what should be done? According to Milton Friedman, it should be invested into physical assets. Why physical assets? Because physical assets will give you two advantages, Surya. The first advantage, it will give you a permanent income. So if you invest in property, your property will start yielding you income in the form of rent. That rent that you receive is nothing else but a permanent income. Yes or no, Surya? And second advantage is that on some future date, that property will give you capital appreciation. So according to Milton Friedman, you should invest in physical assets because money is to be treated as a commodity. Now when money is to be treated as a commodity, Surya, can I say money will yield you returns? Are we clear, Surya? So what are the two advantages? Number one, it will yield you permanent income. Number two, there will be a capital appreciation of your physical asset. Yes, Surya, can I help you with anything else in this theory? I'll come to you, Shivani and Nandini. So somebody has asked me, sir, what is derived demand? Derived means indirect demand. Can money satisfy your wants directly, Kamal? So demand for money is derived. Because money cannot satisfy our wants directly. I am hungry. If I eat money, will my want get satisfied? No. But can money buy me a commodity and that commodity will satisfy my want? So demand for a commodity is direct, but demand for money is the derived, Kamal. So derived demand means something which satisfies your wants indirectly, not directly. Money is a medium of exchange. Money cannot satisfy your wants directly. If I am hungry, will I eat money? No. If I want to cover my body, will I take money, stick it on my body? I will purchase goods. I will purchase food that will satisfy my want directly. I will purchase clothes that will satisfy my wants directly. So Kamal is clear. Now Shivani has a doubt in liquidity preference theory. So Shivani, money has to be used for three purposes: transaction, precaution, and the third one which is added is speculation. Are we clear with that, Shivani? First, keep reply in the chat box. So according to Keynes, money is to be used for three purposes. What are the three purposes? Transaction, precaution, and speculation. Yes or no, Shivani? Quickly, Shivani. It's just a matter of yes or no. Do you agree that money has three functions? Yes or no? Transaction means medium of exchange. Precaution means store value, and speculation means that we have to invest in stock market or bond market. So let's talk about transaction and precaution motive. Shivani, tell me, if your income is more, money demanded for transaction and precaution will be dash. Higher the income, what will be the money demanded for transaction and precaution? Less money will be demanded or more money will be demanded? What is money demanded? The money that we hold. So if your income is more, you will hold more money for transaction and precaution. If your income is less, you will hold less money. Do you agree, Shivani? So the relationship that we get for transaction and precaution is direct. We say that the money demanded for transaction and precaution is dependent on income, which means it is income elastic. Now we have to talk about speculation, or before speculation, I need to give another point of view of interest rate. Now Shivani, if the rate of interest is high, will we withdraw money and use it for the purpose of speculation? The money that you have held for transaction and precaution. So this money is to be used for transaction and precaution. So if the rate of interest is high, my money demanded will remain constant. If the rate of interest is low, then too my money demanded will remain constant, because the money that I have kept for transaction and precaution is not dependent on interest rate. Do you agree with that? Therefore, we say that it is interest inelastic. And I am specifically talking for transaction and precaution. Do you agree with what I have done over here? Is there something that I need to explain again? So money demanded for transaction and precaution is income elastic and interest inelastic. I am talking to Shivani right now. Surya, please wait. Shivani, please reply in the chat box if you have understood or not. Shivani, I need a reply from you. Are we clear till here? Waiting for your reply. Kindly let me know in the chat box. Good. So Shivani, then there is money demanded for speculation purpose also. Speculation purpose also, it is dependent on income and interest. So if income is more, money demanded for speculation will be more. If income is less, money demanded for speculation will be less. That means again it is income elastic. So whether it is transaction, precaution or speculation, it is always income elastic, dependent on income. The money that I demand for transaction is dependent on my income. The money that I demand for precaution is dependent on my income. The money that I demand for speculation is dependent on income. So it is income elastic. Yes, Shivani. Keep replying beta. If you have understood, then only I'll go to the next part. Is this part clear? If yes, then I would want to go to the next part. So if the rate of interest and money demanded are to be compared, Shivani, at a higher rate of interest, should you hold more money for the purpose of speculation or should you invest? So if the rate of interest is high, I will hold less money, I will invest more money. And if the rate of interest is low, I would rather hold more money and invest less. So Shivani, with interest, the relationship is inverse. And the money demanded for speculation purpose is dependent on the rate of interest. If the rate of interest is high, I will hold less money for speculation. If the rate of interest is low, I will hold more money for speculation. That means this will be written as interest elastic, Shivani. Let me know in the chat box, Shivani, if you are clear. Now, since the relationship is inverse, the curve will be a downward sloping curve. Now, at a very high rate of interest, say 10%, I will hold less money, Shivani. Because at 10% rate of interest, I will invest more. So, I will hold less. If the rate of interest comes down to 8%, I will hold a little bit more. If the rate of interest comes to 6%, I will hold even more. If the rate of interest comes to 4%, so what is happening? Shivani, can I say as the rate of interest is falling down, the money demanded is increasing. Now, Keynes assumed that at 2% rate of interest, people will hold all their cash balance. Keynes believed that rate of interest cannot go below 2%. So at 2%, if you observe, this is a horizontal line parallel to x-axis. People will start to hold all the money that they have with them. Because at 2%, what will people expect? That rate of interest will not go below this. So the only thing that will happen is that rate of interest will rise. So will you like to invest at 2% or will you like to invest at 4%? Obviously at 4%. Therefore at 2%, I will hold my entire money, wait for the interest rate to go up and invest my money at that point of time. So at a 2% rate of interest, I will hold all my cash balances, and this is called as liquidity trap. Shivani, Palat, are we clear? I am waiting for your reply in the chat box. Let me know if we are clear or not. Have we understood or not? Be a little fast. Is there something that I should explain in this again? Clear. So now, Shivani, I am giving you two situations. You have to answer me that. Will you answer? Suppose your current rate of interest is 8% and normally the rate of interest in the economy is 6%. What will you do, Shivani? Will you hold more money or will you invest more money? So when this is the situation, what will be the money demanded? if the current rate of interest is greater than the normal rate of interest, will people hold more or will people hold less? My current rate of interest is higher than the normal rate of interest. Therefore, Shivani, money demanded will be less. Why? Because first reason, I am getting 2% extra than the normal rate of interest. Normally in an economy, the rate of interest is 6%. But what banks are offering or bonds are offering is 8%. So am I encouraged to invest? Yes or no, Shivani? I have a question for you. You need to answer that question to me. What will people do? Shivani, please reply. At a higher current rate of interest, what will be the money demanded? Money demanded will be less. Why will the money demanded be less? Because first reason, I am getting 2% extra. Second reason, Shivani, if I have a bond of 8%, and in the future the rate of interest falls to 6%, you have a bond at 8%, and in the future if the rate of interest is 6%, whose bond value will be higher? 8% bond or 6% bond? I am waiting for a reply. You have a bond at 8%. The rate of interest has fallen down to 6%. Whose bond value will be higher? 8% rate of interest bond value or 6% rate of interest bond value? Whose bond value will be higher? 6%. Oh God. Shivani, you are getting 8%. Somebody is getting 6%. How can 6% bonds value be more than 8% bonds value? Don't you think you are earning higher rate of interest? So the person who earns a higher rate of interest, that value will be higher, and not a bond which is at 6%. Yes or no, Shivani? So beta, the bond value will be higher of that bond whose rate of interest will be higher. Shivani, assume that you have invested 1000 at 8%, which means you will get a return of 80 rupees. Yes or no? Now suppose if somebody invests at 4% to earn rupees 80, he will have to invest 2000 rupees. Which means the person who has a higher rate of interest will be able to have capital gains in the future when the rate of interest falls, Shivani? If you have not understood, you can let me know. Am I clear, Shivani? Okay is not an answer. If you have not understood, you need to ask. Am I clear with this? So if there is 4% rate of interest, if I want to earn 80 rupees, then I will have to invest rupees 2000. Which means, Shivani, I repeat, at higher rate of interest, people are encouraged to invest more because of two reasons. Number one, you get a higher rate of return. Number two, you will get capital gain. Do you agree with this statement of mine? Reply in the chat box. Now tell me, Shivani, if the current rate of interest is less, then money demanded will be more. What is the current rate of interest? 4%. What is the normal rate of interest? 6%. So will people invest at 4% or hold money? Comparing with the normal rate of interest. Normally the rate of interest in the economy is 6%. Current rate of interest is 4%. Will a person invest at 4% or wait for the market to get back at 6%? Tell me, Shivani. At 4% rate of interest compared to a normal rate of interest of 6%, are people encouraged or discouraged? Will they invest money or will they hold money? Is 4% a better opportunity than 6% or 4% is a lesser better opportunity than 6%? Shivani, are you there? If the current rate of interest is 4%, the normal rate of interest in an economy is 8% or 6%, what will the person do? Will he invest more? Shivani, is 4% better than 6%? You invested rupees 1000 at 4%, you will get 40 rupees. If you invest 1000 at 6%, you will get a return of 60 rupees. Which investment opportunity is better, 4% or 6%? Will you invest more money at 4%, Shivani? Ayyo, you are wrong, beta. At 4%, I will get lesser returns. I will hold more money. No, beta. When the rate of interest is less, the money demanded is more, Shivani. People are not encouraged to invest because the rate of interest that they are getting is lesser. They will expect the rate of interest to rise. So, Amma, I am asking you, what is the situation? So, Shivani, at 4%, will you invest? Yes or no? Quickly. At 4% rate of interest, we are not encouraged to invest because the returns that we get are lesser. And in the future, will there be capital gain or will there be a capital loss? You have a bond of 4%. In the future, it will get back to 6%. Then will you get capital gain at 4% or will you have a capital loss at 4%? So here we invested more because the rate of interest was higher and there was appreciation. Over here we will invest less because the rate of interest forgone is less and there will be appreciation. I should have written capital gain. And over here there will be a capital loss. Are we now clear, Shivani? Yes, beta Shivani, are we clear? Please reply in the chat box with a yes or a no. If you are not clear, with what are you not clear? Okay, you are clear. Now, Surya, you had another doubt. What is your doubt, Surya? Surya, are you there in class? Palat Mohammad Faz, are we clear? What about others? Only Tobin's theory or Baumol and Tobin's theory, Surya? So only Tobin's theory is behavior towards risk. Now in behavior towards risk, if a person is a risk taker, higher the risk, higher will be the returns. So money demanded, risk ज़्यादा तो returns ज़्यादा. Risk less, risk returns will be less. So first he explained that every person has a different risk appetite. Somebody who can take a risk, he will get higher returns. Somebody who does not have a risk taking ability, he will get lesser returns. Are we clear with that? Then he said that there is something called as taste of an individual. Not everybody will have the same taste of assets. Now, if I ask my father where does he want to invest his money, he will say, I will invest in property. If I ask my brother where will he invest his money, he will say, I will invest in gold. If you ask me, I will invest in stock markets. So everybody has a different taste towards the financial assets. Just the way we have different taste buds in eating food, similarly people will have different type of a taste while investing into an asset. So Surya, I gave you an example. Before I get married, my risk taking ability was much higher. There was no responsibility on my head. I was the alone person. So I used to invest all my money in stock market. But as soon as I got married, my taste towards an asset changed because there was a responsibility in my life. I had to take care of my wife and myself. So then I slowly and steadily took lesser risks and invested in mutual funds. Then 2 years ago, we gave birth to a child. So now I am all the more scared because I have to take care of myself, my wife, my child. So what have I done? I have invested in PPF, Public Provident Fund, in which returns are lesser, but the money is secured. So the taste of the individual is different and it changes from time to time is the concept which talks about behavior towards risk, Surya. Are we clear, Surya? Is there anything else that I can help you with? If you have not understood, Surya, please let me know. Okay, sir, is not the right answer. What is it that you have not understood? Yes, Nandini, please wait for a minute. Let me first clear doubts of Surya. Surya, is there something that you have not understood? Please let me know in the chat box. Understood. Now, Deepika, Nandini has a doubt in inventory approach theory. Sure, Surya. Now, beta, in inventory approach, first of all, we do not treat money for transaction precaution and speculation. Am I clear with that, Nandini, first? So see, inventory approach theory was given by Baumol and Tobin. According to Keynes, I am giving you a distinction between both the theories. Keynes believed that money should be used for transaction, precaution and speculation. Separate things. Wrong answer, Surya. Inventory theory is not about physical assets. Baumol described money as a real cash balance. We do not keep it separately for transaction, precaution and speculation. He said money is a stock. You use it wherever you want to use it. Transaction, precaution, speculation. It is not specific that this much money is for transaction, this much money is for precaution, this much money is for speculation. If the opportunity is right, invest the money. If opportunity is not right, use for transaction. Do whatever you want. Treat money as a stock. Yes, Nandini. So Keynes believed that money should be used for transaction, precaution, speculation, whereas Baumol believed that money should be treated as stock. Give me a reply, Nandini. Are we clear? Nandini, if you reply, I'll be able to go to the next part. Now, second point, Keynes believed that money demanded is a function of income and interest. But Baumol believed that it is a function of income, interest and brokerage fee or a transaction cost. cost of transferring cash balance into interest bearing bonds. So what is the cost of transferring cash balance into interest bearing bonds? Is a brokerage or a transaction cost. So Keynes believed that there are only two determinants of money demanded, that is income and interest. But Baumol believed that there are three factors which determine. So what are the three factors? Income and interest for sure, but along with that a transaction cost, Nandini. Are we clear with that one as well, Nandini? If yes, I'll go to the third part. Please reply in the chat box. Are we clear with this? Now, Keynes believed that money demanded for transaction purpose is not a function of interest. If you remember, we had written money demanded for transaction is interest inelastic. So according to Professor Keynes, money demanded for transaction purpose is not a function of interest, whereas Baumol said that money demanded for transaction purpose is a function of interest. So Nandini, suppose if I require 1 lakh rupees to run my house, will I require this 1 lakh rupee on day one itself? The answer is no. So what did Baumol and Tobin say? That let us say you require 25,000 rupees per month to run your house, per week to run your house. So in the first week you will require only 25,000. Then why are you holding the entire 1 lakh for the purpose of transaction and precaution? Invest this 75,000 into an interest bearing bond. Earn some income in 1 week. Then out of that, remove 25,000, use it for week number 2. The balance 50,000 will be invested. Week number 3, withdraw 25,000. Balance 25,000 will be invested. And at the end of the month, withdraw the balance 25,000. So according to Baumol, money demanded is dependent on interest. But according to Keynes, money demanded is not dependent on interest. Are we clear, Nandini? Yes or no? Are we clear or are we not clear? Are we understanding or we are not understanding? Now, you tell me that what will be the scenario in the following case. If the transaction cost is high, Nandini. Now you have, see, it is easier said than done. Baumol said that you keep 25,000, invest the balance 75,000. As I told you, it is easier said than done. Now Nandini, if imagine transaction cost is more, will you invest the money? Transaction cost means brokerage. Now imagine the brokerage is 1,000 and your returns are 800. Should we invest if the transaction cost is high? Yes or no? If the transaction cost is high, should we invest? No. So if investment will be less, money demanded will be more. If transaction cost is less, investment will be more. The demand for money will be less. Now tell me, if transactions costs are greater than returns. If the transaction costs are greater than returns, my investment will be less. Therefore, money demanded will be more. If transaction costs are equal to returns, then also I will not invest because it's not worth the risk. And therefore, money demanded will be more. And Nandini, if my transaction costs are less than returns, then investments will be higher and money demanded will be lesser because my returns are greater than my costs. Do you agree, Nandini? Are we now clear? Have we all understood all the theories? So under cash transaction approach, MV should be absolutely correct, Nandini. So I hope we all are clear that there are total of 6 theories. I have explained all the 6 theories in detail. Is there anybody else in the classroom who wants me to explain any of the concepts again? Kamal, can money satisfy our wants directly or money satisfies our wants indirectly? Absolutely correct, Nandini. Kamal, if you are there in the classroom, the demand for money is a dash. Direct or indirect, everybody else can reply. Okay, Surya, thank you. So our target was to complete unit 1, 2 and 3. Very good, Kamal. So can I say demand for money is derived, it cannot satisfy our wants directly. Now we have just 2 more days left. And therefore I have no idea how are we going to complete chapter 8 along with chapter 3 and 4. So in tomorrow's class, you tell me whatever are your doubts and difficulties in unit 2 and in unit 3. I will solve only doubts because the amount of time that we have is much lesser. I had planned to complete the entire chapter 8 in today's class, which unfortunately we could not complete. But that is not a problem. That can happen at times. I hope we all are clear and you all have understood whatever was explained in today's class. Is there anything else that I can help you with in unit number 1? Are we all clear? So beta, you tell me, do we have doubts in chapter number 3, that is theory of production and cost? We have 2 days and we have 3 chapters to complete. Obviously, my target was to complete microeconomics chapter 3 and chapter 4 1 day each. But I believe you have doubts in chapter number 8. So now, due to lack of time, we will have to manage something or the other. That's great, Kamal. So I request you to come revised with unit 2 and 3 for tomorrow's class. If you have doubts, I will solve those doubts. If you don't have doubts, I will directly start with chapter number 3. Works for everybody. Please give me a reply in the chat box. Shivani is not replying. Better Shivani, I hope you are also clear. Nandini is clear. So Surya, tomorrow chapter number 3 and day after tomorrow chapter number 4. But that will be just a revision. You will have to come revised with it. If you don't know a concept only, then I don't know how are we going to complete it in 2 hours. Do we know what are the formulas for M1, M2, M3, M4? Are there any doubts over here? The measurement of money supply, if money supply is more, inflation. If money supply is less, there will be recession. There are 4 concepts in measurement of money supply: M1, M2, M3, M4. Are these formulas clear? Give me a reply in the chat box with a yes or a no. M1 is currency notes and coins with the public, plus demand deposits plus other deposits with RBI. M2 is M1 plus savings deposit of the post office savings bank. M3 is equal to M1 plus net time deposits with the banking system. Net time deposits means demand, fixed deposit and recurring deposit. M4 is equal to M3 plus total deposits with the post office savings bank. Is this formula clear with everyone? Then similarly, we have a formula for NM1, NM2 and NM3. This is only the banking system, whereas L1, L2, L3 is banking plus non-banking. Is there a need for me to revise any of these 10 formulas? 4, M1, M2, M3, M4, 3, L1, L2, NM1, NM2, NM3 and L1, L2, L3 have another 3 formulas. Are we clear with the formulas? Yes, everybody. Can you quickly reply, please? All clear then? Are we done? Have we understood? Shall we go ahead? Surya, Shivani, Nandini, Kamal. See, if you are coming to a revision class without revision, then we are in a dangerous situation. We should be coming revised and asking the doubt. So I repeat one last time. Tomorrow, first 15 to 20 minutes, I will help you with whatever you want in chapter number 8. If I get doubts, I will solve those doubts. If there are no doubts, I will go to chapter number 3. Is that okay? Give me a reply in the chat box with a yes or a no. Okay, Surya, what about others? Can I expect you all to come revised? Nobody is replying only. Okay, Nandini. All right, then that's it from me today. Thank you so much. Please like, share, subscribe, comment, hit the bell icon. Bye bye. Take care. I'll see you all in tomorrow's class. Thank you so much. Bye, everybody. Take care.